Then there's the debt machine. Student loans, credit card balances, mortgages, they all promise freedom, but often shackle you for decades. The average American household debt hit over $100,000 in Q1 2024. That's a heavy burden. The system thrives on complexity. Jargon-filled prospectuses, endless financial products, and conflicting advice from experts leave you paralyzed. Who profits from your confusion? Certainly not you. They exploit your psychology. Fear of missing out on the next big tech stock, or panic selling during a dip. These emotional reactions are exactly what the smart money preys on, often leading to retail investor losses. The media constantly pushes narratives of overnight millionaires and get-rich-quick schemes. This creates unrealistic expectations, distracting you from the disciplined, long-term wealth building that truly works for sustainable financial freedom. Even taxation plays a role. While necessary, the complex tax code often benefits those with sophisticated accountants, allowing them to legally minimize liabilities. The average worker, however, pays a higher effective rate, hindering wealth accumulation. Many are trapped in the work-to-earn cycle, exchanging hours for dollars, never building assets that work for them. This keeps you reliant on a paycheck, vulnerable to economic shifts, and far from true financial independence. Even your 401k, while a good start, might not be enough. With rising life expectancy and healthcare costs, many find their retirement savings fall short. The median 401k balance for 55, 64-year-olds is around $60,000, far from adequate. Schools rarely teach practical financial literacy. You're expected to navigate complex markets, manage debt, and plan retirement with minimal guidance. This knowledge gap is a systemic flaw that disadvantages many. The soaring cost of living, especially in major U.S. cities, makes saving a monumental task. A median home in San Francisco costs over $1, 3-night millers, while average rent in New York City exceeds $3,500. It's a constant uphill battle. The pressure to keep up with the Joneses fuels consumerism, driving you to spend on depreciating assets instead of investing. This societal expectation, often amplified by social media, is a subtle trap for your long-term wealth. Every dollar spent on consumption today is a dollar not invested, losing out on the power of compounding. That lost opportunity cost, especially for young investors, can amount to hundreds of thousands over a lifetime. Time is your biggest asset. Powerful corporate lobbies heavily influence financial regulations, often creating rules that favor large institutions over individual investors. This systemic bias makes it harder for the average person to compete and build generational wealth. The result? A widening wealth gap. The top 1% now hold over a third of the nation's wealth, while many struggle paycheck to paycheck. This isn't just an economic issue. It's a fundamental challenge to your financial future. This isn't about blaming the system. It's about understanding its mechanics. While the top 1% accumulate wealth, it's often through disciplined adherence to core investment principles. They don't just participate. They strategize. What sets them apart? One fundamental principle is the power of compounding. Historically, the S&P 500 has returned an average of about 10% annually. A consistent $500 monthly investment, compounded over 30 years, could grow to over $1 millers. Thanks to this exponential effect. Diversification isn't just a buzzword. It's a critical risk management strategy. Putting all your eggs in one basket, like a single tech stock, exposes you to immense volatility. A balanced portfolio across different asset classes mitigates risk, protecting your capital. The allure of quick profits leads many retail investors to day trading, often resulting in significant losses. Data suggests over 80% of day traders lose money over time. True wealth is built not through chasing daily swings, but through a long-term, patient approach. Dollar cost averaging is a powerful yet simple strategy. Instead of timing the market, you invest a fixed amount regularly. This averages out your purchase price, reducing risk and capitalizing on market fluctuations without emotional stress. It's consistency, not perfection. Beyond investment tactics, fundamental financial literacy is your shield. Understanding personal finance, budgeting, and tax implications empowers you. It's not about memorizing terms, but building a robust framework for every dollar earned, saved, and invested. Before you invest, master your cash flow. A well-structured budget, like the 50-30/20 rule. 50% needs, 30% wants, 20% savings/debt, ensures you're consistently saving. This disciplined approach frees up capital for investment, becoming your financial engine. Not all debt is created equal. High-interest consumer debt, like credit cards averaging 20% APR, can erode your wealth faster than any investment grows. Prioritize eliminating bad debt, then strategically leverage good debt, like a low-interest mortgage, to build equity. An emergency fund isn't an investment, it's financial armor. Aim for 3-6 months of living expenses in a liquid, accessible account. This buffer prevents you from selling investments at a loss during crises. Maintaining your long-term strategy, even when life throws curveballs. Inflation silently erodes purchasing power. With recent inflation rates reaching 40-year highs, cash loses value rapidly. Strategically investing in assets like real estate, commodities, or dividend-paying stocks can hedge against inflation, preserving your wealth's true value. Value investing, championed by legends like Warren Buffett, focuses on buying assets for less than their intrinsic worth. This requires deep research, patience, and a contrarian mindset. It's about finding hidden gems, not just following the herd into popular, overvalued stocks. Your asset allocation should evolve with your life stage. A young tech worker might tolerate more risk, with a higher percentage in growth stocks. Someone nearing retirement, however, needs a more conservative portfolio, emphasizing bonds and stable income for capital preservation. Tax efficiency can significantly boost your long-term returns. Utilizing tax-advantaged accounts like a 401k or Roth IRA can save you thousands in taxes over decades, allowing more of your money to compound. Don't let Uncle Sam take an unnecessary cut. Human emotions are often the greatest saboteurs of financial plans. Loss aversion, fear of missing out, and herd mentality drive irrational decisions. Recognize these biases within yourself and stick to your disciplined strategy, especially when others panic or get greedy. Ultimately, the goal isn't just to accumulate wealth, but to achieve financial independence. The FIRE movement, for example, advocates aggressive saving and investing to retire decades early. It's about freedom. Freedom from debt, freedom to pursue your passions, and freedom from the system's demands. Achieving this freedom isn't about chasing hot stocks or meme coins. It's about strategic asset allocation, leveraging vehicles like 401ks, ERA, and low-cost ETFs. Historically, the S&P 500 has averaged over 10% annual returns, a powerful engine for long-term wealth. The system thrives on your impatience and fear. It wants you to react emotionally, to buy high and sell low. Your defense is a disciplined long-term strategy, understanding compound interest, and consistently investing, regardless of market noise. This is how you build true generational wealth. Remember, the biggest asset you have is your financial knowledge. Continuously educate yourself, challenge conventional wisdom, and seek out diverse perspectives. This isn't just about money, it's about reclaiming control of your future from forces that prefer you remain dependent. So, are you ready to stop playing by their rules? Start by defining your financial goals. creating a budget, and automating your investments. The system wants you broke, but with knowledge and discipline, you can fight back. The power to win is in your hands.